Welcome to today's lesson on the secular flow of income. So we shall be dealing more with statistical applications. We shall be dealing more with tutorials on this topic. And before we go to tutorials, we will first of all have a brief demonstration or discussion on what the secular flow of income is, the various sectors that are involved when we are talking about the national income circuit, the two-sector economy, the three-sector economy, and the four-sector economy, all the methods that we can use to arrive at national income equilibrium and all of that. So we shall be doing diagrammatic illustrations as well. So when we talk about the national income circuit or the secular flow of income, we are simply looking at an endless loop of movement, how money leaves from firms or business units to households through payments for factor incomes. And what are factor incomes? Payment of factor incomes, Factor incomes are those payments that are made to suppliers of factors of production. When households supply labor, producers have to pay for that labor through what we call wages. So money moves from producers to their household through wages. When they provide capital, provide land, money also moves from producers back to them through interest on capital, through wages on labor. And in turn, households also send back this money. They also spend and send money towards producers by consuming the goods that the producers sell to them. So you see, it is an endless cycle of movement. So we are going to be looking at the classification of economies, how statistical analysis can be done as per two-sector economy, a three-sector economy, and a four-sector economy. Starting with the two-sector economy, it is that economy wherein we have only two stakeholders. That is to say, we have only households and we have only firms. There is no government. It is not open to international trade. We can also call it an ungoverned economy. So in a two-sector economy, we have households and then we have firms or business units. So households consume. Households, they spend by consuming. The expenses made by households are called consumption, while the expenses made by firms are called investment. We do not have the government here. We do not have international trade. So therefore, looking at the secular flow of income, if you want to illustrate the concept of the equilibrium in this type of an economy, you can use two methods. You can use the aggregate demand approach, and then you can also use the injections, leakages, or withdrawal approach. Looking at the aggregate demand approach, it is that concept which says that an economy is at equilibrium when its income is equal to aggregate demand. An aggregate demand is simply a summation of expenses that are made by all the stakeholders in an economy or all the entities in an economy. Aggregate demand refers to expenses made by households, which we call it consumption. It is also made up of expenses made by firms, which we call investment, made up of expenses made by the government, which we call government expenditure, denoted by D. That is if we are in a governed economy, and also expenses that are made on export and import if we are in an open economy. So for now, using the aggregate demand approach, income is at equilibrium when Y, our national income, is equal to aggregate demand. And since we are in a two-sector economy, aggregate demand here is a summation of expenses by households called consumption and expenses by firms called investment. So we are saying that in a two-sector economy, using the aggregate demand approach, income is at equilibrium when Y is equal to C plus I, consumption plus investment. And then using the injections withdrawal approach, or leakages approach if you want, income is at equilibrium when all injections are equal to all withdrawals or leakages. When all the injections simply mean expenses or economic activities that bring money into the economy. Anything that brings money into the economy, that boosts the circulation of income in an economy, such as investments, such as government expenditure, such as exports. All of them, they boost the flow of income in an economy. Meanwhile, leakages or withdrawals are simply any expenses that are made not on goods inside the country. If there is an expense that is made and those expenses are not made on goods produced in the country, that will be a leakage or a withdrawal. Because when income is produced by goods and services, when goods and services produced in a country bring forth income, that income is supposed to normally be spent on those goods again in the country, so that money remains in the circular flow internally. But when that money is rather spent on savings, that will leak out, that will withdraw money from the circular flow. When that money is rather spent on imports, there is cash outflow, that is recorded as withdrawals. When that money is spent on taxes, on paying taxes, direct or indirect, direct taxes, it will lead to leakages or withdrawal from the circular flow of income. So, using the withdrawal and injection approach, income is at equilibrium when all injections are equal to withdrawals. And injections in a two-sector economy is only comprised of investments alone, which will be equal to withdrawals from a two-sector economy, which is only savings alone. So if you are asked to solve for national income equilibrium using the leakages and withdrawal approach in a two-sector economy, you will equate your S, that is savings, to your investment. So operating under a three-sector economy, which is also called a governed economy, it shows that the government has been introduced. We now have government presence. So using the aggregate demand approach, income is at equilibrium here when Y is equal to consumption by households, investments by firms, and then government expenditure by the government. That is using the aggregate demand approach. Then using the injections, leakages, or withdrawal approach, income is at equilibrium here when all injections are equal to withdrawals or leakages. And we have two injections under the three-sector economy. Injections brought about by investments from firms, injections brought about by government expenditure, since we now have the government present. And then we have two withdrawals or leakages, which is made up of savings, and then we have taxes imposed by the government. So if you use either of these formulae, it should give you the same answer, because using the aggregate demand approach is as good as using the injections withdrawal approach. And then income is this is a three-sector economy. And then under a four-sector economy, in a four-sector economy, that is what we call a governed and an open economy, open to international trade. So in a four-sector economy, using the aggregate demand approach, income is at equilibrium when Y is equal to C plus I plus G plus X minus M. When we talk about an open economy, we are referring to the presence of international trade. So international trade is now involved. And international trade has to do with net exports, that is exports minus import. And then using the injections withdrawal approach, we know that all injections must be equal to all leakages or withdrawals. And the injections in this economy are three of them. We have investments, we have government expenditure, and we have exports. And then the leakages or withdrawals in this economy, we have savings, we have taxes, and then we have imports. So you see that exports and imports have come in for the four-sector or open economy. So basically, this is a brief summary of how you solve for national income equilibrium under all the sectors, the respective sectors of the economy. Now let us look at consumption as an aspect of aggregate demand. It is very imperative. Let us look at the consumption function. Okay, so consumption, we will be looking at consumption, which is simply the expenses made by households on goods and services. And the consumption is made up of two main components. We have consumption denoted by C is made up of two main components. We have A, which is autonomous consumption. That is consumption that doesn't depend on income, consumption that can be made even when the income level is zero. And then we have income-induced consumption. Income-induced consumption here is a combination of the marginal propensity to consume and then income itself. So we have A is equal to, C is equal to A plus B what? B here stands for the marginal propensity to consume, A stands for autonomous consumption, and Y stands for income. If you see in some situations they say C is equal to A plus BYD, it means that what? We are dealing now with disposable income. And what is disposable income? Disposable income simply refers to what an individual is left with after taxes have been deducted from his gross income or nominal income. That is YD is equal to Y minus T plus transfer payment. So this is the general formula for disposable income. But if we do not have transfer payment, your YD will be equal to Y minus T. That is income minus taxes. And then we are saying that the component of the consumption function here, A stands for autonomous consumption. Autonomous consumption. And then this B here stands for the marginal propensity to consume. And the marginal propensity to consume simply refers to that proportion of an individual's income that is spent on consumption. If your income happens to change, what proportion or what part of that income are you going to spend on consumption? What part of that extra income do you spend on consumption? That is what we mean by the marginal propensity to consume. And the marginal propensity to consume, MPC, is simply calculated as the change in consumption all over change in income. What is that proportion of your income that has changed, either increased or reduced? What is that proportion of income that has changed resulting to that change in consumption? So when you divide all of that, it is going to give you a figure that is positive and less than 1. That is, it will be a 0 point something. It is greater than 0, less than 1, but positive. So that is what we mean by the marginal propensity to consume. Let us see a statistical example. Let's see a tutorial question and solve together to see. Alright, let's look at this exercise. It says, if consumption is equal to 50 million plus 3/4 Y, determine A, the value of savings, S representing savings, if Y is equal to 200 million francs. B, if investment is 100 million francs, determine the equilibrium income, that is YE. Determine the multiplier. D, if investment rises to 150 million, determine the effect on national income. So let us see what the solution looks like. A says we should determine the value of savings. The value of savings. If income is equal to 200 million, you cannot get the value of savings without looking for the savings function. We need to look for the savings function first. So, solution to A, S is equal to Y minus C. Why? Because we know that Y is equal to C plus S. Your income is equal to consumption plus savings. So in order to get savings alone, what you do is that you can subtract consumption from investments. From your income, it is going to give you your savings. That is why I said S is equal to Y minus C. So therefore, let us apply this and solve for S, so that we can substitute Y wherever 200 million, wherever we see Y, and get the single value, the exact value for savings. So we have S is equal to Y minus C, and then S here is equal to Y minus all of C. C here is given by 50 million plus 3/4 y. When you are subtracting a value from a function, because this is a function, when you are subtracting a value from a function, what you do is that you put it in bracket so that that negative sign multiplies all through. That negative sign affects all the values inside. So what I'm saying is we say y minus, in brackets we have 50 million plus. Let us work with decimals so that it is much easier. 3/4 is the same as 0.75. So we have 50 million plus 0.75 y. I've just divided 3 by 4. It gives me 0.75. Okay, so that is what we have. And then we say S is equal to y. Let us open these brackets by multiplying by negative. We have y, negative 1. We consider this to be negative 1. Negative 1 times 50 million. We have negative 50 million. Negative multiplies 0.75y minus 0.75y. So we have opened our brackets. Now, let us bring like terms together. We have y here and 0.75 also has y. So we are bringing like terms together. But remember that despite the fact that there is a movement on one side of our equation, that doesn't change the equality sign, because the equality sign changes only when, the signs change either from negative to positive only when we are moving over this equality sign. So we are still on one part or one side, of this equation. So nothing changes. So we have S being equal to y. This negative sign belongs to 0.75y minus 0.75y. And then this negative sign belongs to 50 million minus 50 million francs. So S is equal to this minus this. 1y minus 0.75y gives us 0.25y. Then we copy down minus 50 million. Now, our supply function, we will get our supply function from here. Before we substitute, we could substitute directly, but I would like that we should get our supply function. And our supply function has a format in which it must be written, same as our consumption function had a format that I showed you. So the supply function is always given as negative autonomous savings, so what you call the savings, plus the marginal propensity to save, y, or you say negative the savings, or the savings plus savings, income induced savings. SY here stands for income induced savings. So since this is the format, it means that what? That autonomous savings has to appear first before the income induced savings, or before the marginal propensity to save and y. So we have S being equal to, we copy down negative 50 million plus this one now 0.25y. That is our savings function, but the question requested for the amount of savings. So to get the amount of savings, it is simple. What we do is that since they told us that our income is equal to 200 million, we simply substitute wherever we see y, we put 200 million, and then we work with the function. We will simply have the answer. So S here is equal to negative 50 million plus 0.25. Y now becomes 200 million. And then we have S being equal to negative 50 million plus, so negative 0.25 multiplies 200 million to give us what? Gives us 50 million. So we have 50 million. S is equal to negative 50 million plus 50 million gives us 0. So the amount of savings in this economy is 0 if income is equal to 200 million. So that is what you do. So question B says that if investment is equal to 100 million, we should determine the equilibrium level of income. So we said that income is at equilibrium when Y is equal to ADT. That is using the aggregate demand approach. If Y is equal to aggregate demand, then that is our equilibrium income. And in this sector, or in this situation, our aggregate demand is made up of consumption and investment. If we like, we use the injections withdrawal approach, which says that income is at equilibrium when all injections are equal to withdrawals or leakages. And in this situation, our injections, we have only one injection, which is investment. We have only one withdrawal or leakage, which is savings. So we are going to solve with both formulae to see if we will arrive at one answer. We have Y is equals to, let us start with the aggregate demand approach. Y is equal to C plus I. So Y here is equal to, our C is the consumption function, of course, 50 million plus 0.75 Y plus investments. They have told us that we should assume that investment is 100 million. So we have 100 million. So Y here is equal to, we bring like terms together. This plus this gives us 150 million plus 0.75 Y. So we will bring like terms together such that this 0.75 Y crosses the equality sign to meet Y over here. That gives us Y minus 0.75 Y should be equal to 150 million. So when you take Y minus 0.75 Y, it gives you 0.25 Y, which is equal to 150 million. So we were looking for the equilibrium income. We divide all through by the coefficient of Y, which is 0.25. So we have 0.25 Y divided by 0.25 should be equal to 150 million divided by 0.25. So this strikes this, and then when we take 150 million divided by 0.25, it is going to give us 600 million. So that gives us 600 million francs CFA. So that is how you work with your equilibrium level of income. So using the injections withdrawal approach, we said that income is at equilibrium when leakages or withdrawals are equal to all injections. So our leakages or withdrawals in this economy, as per the question, is we have only one leakage or withdrawal, which is the savings function that we solved for. In A, we solved for the savings function when we were to determine the value of savings. We solved for the savings function, and our savings function was, so we will say that S is equal to the loan injection, which is investment, the loan withdrawal, which is savings, and our savings function was given by we had negative 50 million plus 0.25 Y. That was our savings function, which should be equal to the investment which we have been given here, which is 100 million. Okay, we bring like terms together. So this negative 50 million shall move to meet 100 million that way, and it will turn into positive. We have 0.25 Y should be equal to 100 million plus 50 million. So 0.25 Y is equal to 150 million. We are looking for Y, so we shall divide all through by the coefficient of Y, which is 0.25. So we have 0.25 Y all over 0.25 should be equal to 150 million divided by 0.25. So this takes care of this, and 0.25 goes into 150, 600 million francs times, since we were working in millions of francs here. So you see that either formula we use gives us the same answer. We used the aggregate demand approach, and it gave us 600 million. You have used the injections withdrawal approach, and it is still 600 million. All right, C says that we should determine the multiplier. Now, the multiplier in its simplest terms, or in the simplest way possible, the multiplier is a catalyst. The multiplier is that component of an economy that multiplies, that increases, boosts any injection to a more than proportionate level. That is to say, if something is injected, if investment, for example, or government expenditure or exports come into an economy by, let's say, 50 million, the multiplier effect on the national income will be greater than 50 million. Why? Because of this component called the multiplier, which is denoted by K. It is a catalyst that increases the size of every injection in an economy. So the multiplier is always denoted by K, and it has multiple formulae. You can calculate the multiplier using different formulae, and I'm going to use 2 different formulae to show you that it can always give the right answer. The most common of them all is to say that K, the multiplier, is equal to 1 all over 1 minus the marginal propensity to consume. And I told you earlier on that the marginal propensity to consume is that decimal that is always beside Y on every function, be it the savings function, be it the consumption function, the investment function, export or import function, tax function, whatever it may be. This is the consumption function. So the value, that fraction or a decimal that is always written beside Y, stands for the multiplier, the marginal propensity to consume, if it is the consumption function. So our MPC here is 3/4, which is the same as 0.75. So you can work with the multiplier using this formula. You can also use what we call the withdrawal multiplier, and that is given by 1 all over the marginal propensity to withdraw. And the marginal propensity to withdraw here is a sum of the marginal propensities to save, to tax, and to import, if all of them are given. But then in this case, we do not have all of that. We have only savings. We do not have taxes. We do not have imports. We are going to use both formulae, and you see how it is going to give us the same answer. Let us start with formula 1. K is equal to 1 all over 1 minus the marginal propensity to consume. And our marginal propensity to consume is 3/4. In decimals, it is 0.75. 0.75. So our K here is equal to 1 all over this minus this gives us 0.25. 1 divided by 0.25 gives us 4. So that is our marginal propensity, our multiplier. And please, the multiplier is not money. Neither is the multiplier a commodity. So you do not give any unit of measurement to the multiplier. Do not say 4 francs. It is not money, neither is it a commodity. Do not say 4 francs, 4 kilograms, 4 units, or whatever. Just 4. That is the multiplier. And then, using this format, the multiplier will be given by 1 all over the marginal propensity to withdraw. How many withdrawals or leakages do we have here? We have only savings, since there are no taxes and there are no imports. So we shall look at the savings function and also see that decimal, that 0 point something, that stands beside Y in the savings function. That would be our marginal propensity to save. And for the previous question, we solved and said that the savings function was equal to negative 50 million plus 0.25 Y, which means that our marginal propensity to save is 0.25, not 0.25 Y. 0.25 Y is income-induced savings, but 0.25 alone is the marginal propensity to save. So therefore, we have 1 all over the marginal propensity to save, since that's the only withdrawal we have here, which is 0.25. That shows us that our multiplier K here is 1 divided by 0.25, which gives us 4. That is the same answer here. So you can choose to use either the withdrawal multiplier or you use the normal multiplier through the marginal propensity to consume. That was C. Let us see what D has for us. D says if investment rises to 150 million, determine the effect on national income. If investment rises to 150 million, determine the effects on national income. When they say that something has risen to, it means that we are using the final destination, we are using the final value to work with. You understand? But if they say that it has risen by, it shows that it has changed by a particular value. So they have said our investment has risen to 150 million. That means that it was first of all somewhere. So that change in the injection has to be calculated. If it has changed to 150 million, where was it before? It was at 100 million as per this question. So what is the change in investment? The change in the investment is not 150 million. It is 150 million where it has changed to minus 100 million where it was before. So therefore, to get to know the effects of an injection on the new level of income, this is what you do. You say that new income is equal to YO, let me call YO to be the old income, plus change in income. So to know your new level of national income, you say old income, your old level of national income, plus change in income. Now, our old level of income was given. Let us see our new income here, our change in income. Let's calculate our change in income. So we say, but change in income is equal to, how do you get the change in an economy's level of income? You simply say K, the multiplier K. I said it acts as a catalyst. It blows injections beyond the amount inserted or injected into the economy. So we say K times change in the injection, and K here is the multiplier. So change in Y is equal to K, which is 4 times our change in injection. They said investment has changed to 150. So it has changed. That is, we take 150 minus 100 where it was before. It was at 100 before, and then it has changed to 150 as the question states. So we take change in investment is equal to 4 times 150 minus 100 is 50. So change in investment is equal to 200 million francs. That is our change in income. That is by how much our income has changed. So you see that they have injected an extra 50 million into the economy, but the multiplier effect on that economy due to that injection is 200 million. So what you do is that you just take this change in income and add to your original equilibrium level of income. It is going to give you your new income. So we had solved originally, and we got our level of income. Our level of income that we saw before was 600 million. So this is what you do. You say that new income is equal to YO, that is the old income, which was 600 million, plus change in income. So we have new income is equal to 600 million plus 200 million. So your new income is equal to 800 million francs CFA. That is how you calculate it. So that's simple. So that's the solution to this little exercise.